Welcome to The Explainer. We're going to dive right in today, looking at some of the biggest financial disasters in history. And more importantly, our source material offers up a framework for how you can avoid getting caught in the next one.
Okay, so what do 17th century flower bulbs and a 21st century crypto exchange have in common? It sounds like a setup for a bad joke, right? But the answer is they're both on this crazy list of history's worst investments. And what's wild is that even though they're separated by almost 400 years, their stories have some shockingly similar warning signs.
So, this whole journey into financial disaster, it actually starts way back in the 1630s. And we're not talking about stocks or bonds here. We're talking about tulips. Yeah, flowers, a bubble so big, it just destroyed people's fortunes. And then, let's fast forward to our time. The story continues, but now we're dealing with really complex corporate fraud. Think about the collapse of Enron back in 2001. That whole company was basically a house of cards built on shady accounting.
And it's not just corporate shenanigans. We also see these huge, devastating betrayals of trust. I mean, Bernie Madoff, his Ponzi scheme was absolutely massive, cheating investors out of something like $65 billion.
And this isn't just ancient history. This pattern runs right up to the headlines we're all seeing today. Look at the collapse of FTX in 2022. It's the modern version of the same story, a cautionary tale of hype, maybe some mismanagement, all happening in the new digital world.
All right, so let's really get into it. The source material we're breaking down lays out some of these huge investment catastrophes. And here's the thing, when you put them all side by side, you start to see this really clear and frankly dangerous pattern. So, where did this all start? Well, what's considered the very first speculative bubble on record was something called tulip mania back in the Netherlands. People went nuts for these flowers. They became this huge status symbol, and the prices just went astronomical. We're talking about a single rare bulb being worth as much as a luxury house in Amsterdam. But then, in February 1637, boom, the bubble burst. Prices fell 99% in just a matter of days. It was absolute financial ruin for so many people. Okay, now let's jump forward a few hundred years to the dot-com crash. And you'll see the script is almost exactly the same. So much hype, but very little substance. You had all these companies with business models that weren't proven, barely making any money, and their values were just skyrocketing because of all the excitement about the internet. Pets.com is a perfect example, right? They had a huge IPO, raised over 80 million bucks, and then they were completely shut down just 9 months later. And what's really fascinating about this whole thing is that this pattern, it's not just for stocks and financial markets. It can happen with anything, even collectibles like Beanie Babies. Remember that? In the late 90s, people were absolutely convinced these little toys were a guaranteed investment. Some of the rare ones were selling for thousands of dollars. But then the company just made too many, the market got saturated, and poof, the values completely collapsed for almost all of them. So, what's the takeaway here? What do we learn from all this? Well, the source we're looking at argues that these events, from tulips to tech stocks to toys, they're not just random bad luck. No, they all share these common, really dangerous traits that act like big, flashing warning signs. Right, so you look at Enron and you see this super complex, fraudulent accounting that hid what was really going on. Then you look at the dot-com bubble and you see this emotional herd mentality where everyone just jumped on board. The pattern is always there. And here's the key takeaway from the source. It's not just about the numbers, it's about human psychology. That's what really drives these bubbles. It's this toxic combination of hype, which makes people act on emotion instead of logic, and a total lack of doing their homework, which means they don't see the cliff until they're already falling off it. Okay, so that's the big question, isn't it? How do you avoid becoming the next victim? How do you not get caught up in the next bubble? Well, the article our source material pulls from gives us 5 key rules for a solid defense. And these steps are pretty straightforward, but they're super powerful. Do your homework, don't just believe the hype, diversify your portfolio so you're not all in on one thing, keep your emotions out of it, and maybe talk to a professional. All of that is great defensive advice. But the main speaker in our source material says that's not quite enough. They argue you need a more fundamental framework to help you prioritize your decisions the right way. And that brings us to the real heart of their argument. To truly steer clear of these kinds of disasters, they've come up with this simple but really powerful test you can apply to any investment. It's an acronym they call LASER. So LASER stands for Liquid Assets Safely Earning Returns. Now, here's the crucial part. It's not just what those four words are, it's the order they're in. The source makes a huge point that most of these investment disasters happen because people are obsessed with the R, the returns, while they completely ignore the first two more critical parts, liquidity and safety.
And this table really drives the point home. You can basically score any investment from 1 to 10 on each of these pillars. So let's take a hyped up stock like Pets.com. On rate of return, yeah, the hype was a 10 out of 10. Everyone thought they were going to get rich. But what about liquidity? And more importantly, what about safety? The safety of your actual money. On those, it was a disaster waiting to happen. It scored terribly on the two things that should have been the highest priority.
Okay, so if the laser framework is the test, then what kind of strategy actually passes it? Well, the source uses this exact framework to show an approach that kind of flips that whole traditional risk-reward idea upside down. And their whole approach is really built around a core idea from, you guessed it, Warren Buffett. Rule number 1, never lose money. Rule number 2, never forget. Rule number 1. The main goal isn't to chase the biggest possible return. The main goal is to protect your money. That makes safety the absolute, non-negotiable starting point.
So how do they do that? One of the key features they talk about is something called a lock-in and reset mechanism. The idea is this: when the market has a huge crash, like what we saw in March 2020, this feature protects your principal. You're shielded from the losses. You don't lose a dime. As they put it in the source, zero is your hero because you're not going backwards.
And then comes the reset part. So after you've locked in your value and avoided the losses, your new starting point for growth is reset at the bottom of the market. This is huge because it means you get to capture all of the upside when the market bounces back. In the example they give, from March 2020 to March 2021, this strategy led to a 61% gain. And because of the specific type of account they're talking about, that gain can be accessed tax-free down the road.
So they argue that it's this unique combination of features that really nails their laser test. You've got safety, thanks to that 0% floor, so you can't lose money. You've got a great rate of return because you're capturing the rebounds. You have high liquidity, since you can get to your cash with tax-free loans against the account. And of course, you have major tax advantages. It's this whole structure, they say, that helps investors avoid all those historical traps we've been talking about.
And that really brings us to the final, most important question from this whole analysis. When you look back at everything, at Tulip Mania, the dot-com bubble, all of it, the source material is really asking you to think about this. Is your financial strategy built on chasing the latest hype, or is it built on a solid foundation, one that's designed to protect you from those patterns that history has shown us again and again will repeat themselves?